Good evening, everyone. So we are now on our week number 7, halfway across with our topic for the semester, and then later on we're gonna do a 2-week project. Basically, instead of having an assignment, we're just gonna do a project by analyzing a financial statement with one company. But for now, we're almost there. We are now gonna discuss cost of capital, right? So let's go back to some of our topics before. If you are the CFO, right, the Chief Financial Officer of the company, and then you would like to do a project. Why? Because you always want to grow the business. If you are in the business of doing retail projects, or meaning, for example, selling, you wanted to increase new products, or you want to introduce new products, or even increase the distribution centers that you have, maybe new stores, even buying your own warehouse instead of renting a warehouse, or having your own distribution system, maybe more delivery trucks, or hiring more, or expanding basically. So as you expand the business, you need capital. And then the question is, if I do this project, how much return will it give me? Like an ROI, right? ROI is return on investment. And then the question of, is it enough ROI in order for me to say that that project is actually good? If you're the CFO, you are given a couple of projects by the operations team. The chief operating officer would say, "Hey, I would like to expand the market in another geographical location. Give me this much money to invest on, and I'll deploy that capital, and it will give you an ROI of say 15%." Now, the other project, another operations director would say, "Hey, I want another 5 million, similar to the first one, but it would give you 14.5%, or like maybe 16%, give and take, a range of return of investment." Now, the question is that one is of 15%, one is 14.5 to say 16% as a project. Which one would you choose? In actuality, you would have more than one project in a given year, right? That will be concurrent, or that you may need to fund. And then the question of, do you want to fund A or B? And then, are the return of investment that they're saying is actually good or not? So the question now would be, what is the cost of capital? If you're going to be funding those projects A and B, is 15% a good recovery? 14.5 to 16% a good recovery? Maybe your cost of capital internally is actually 20%, or say 18%. So a return of 15% or 14.5 to 16% is not good. It's basically going to give you a negative return, right? Like the net return is negative. Why? Because the cost of capital would be the cost of you obtaining a loan, or issuing bonds, debt financing, and using some of your internal funds through retained earnings in order for you to fund that project. The cost of capital is always a question of, if I use my funds as a company, both internal financing, meaning as a company grows with retained earnings, right? Or you have net income. Net income becomes retained earnings. And then you store that for you to use as dividends. But for some, you want to use that to reinvest back to the business. Reinvesting back to the business means that you're going to be using it to deploy to fund assets. If it's not enough, you might need to borrow money from the bank, and the bank will give you a rate. A simple calculation would be project A, $5 million worth at 15% return on investment. Project B, 5 million worth also, 14.5 to 16% rate. But for example, it's a full-blown debt financing. The only way that you would be able to fund those projects, or one project only of 5 million, is by borrowing $5 million from the bank. And then the bank would say, "Hey, the rate that I'll give you is actually 18% or 20%. So your cost of capital, a purely debt financing, is actually more expensive compared to the return that you're going to be getting. So that's why I would say if you're the CFO, project A and B, not a good thing. Or let's go back to the drawing board. What were your assumptions? Maybe you were too conservative on your assumptions. Let's take a look at it on what is reality or which is more realistic, right? Now, cost of capital, as we've been talking before, is actually two things. It's the cost of debt financing and the cost of equity financing. So sometimes it can be combined, right? You might be loaning a portion of that 5 million, say 3 million, and then the rest that you're using, the 2 million difference from the 5 million. So 5 million project minus 3 million from your loan from a bank. And then the 2 million comes from a equity financing, meaning that retained earnings accumulated or accumulated net income, which is called retained earnings, will be your internal financing component. So you need to place a number, like what finance does, right? Like we quantify things. We need to place a what is the cost of capital on both the debt and then also the equity. And of course, there's a weight, right? So 3 million for debt, 2 million for equity. What's the percentage of the rate for the 3 million of debt? What is the percentage of the equity? And then when you weight it, then basically that will be your benchmark to compare with the return on investment. I wanted to give you an end to like this. That's basically the gist of what we need to talk about in week number 7. Of course, like in any other cases that we've been doing, we have a calculation, right? Um, it's good for you to understand what's the reason why cost of capital is important, and then we're going to be applying it next week further on a project calculation basis. But for now, we need to understand how to calculate cost of capital, what consists of cost of capital, and then also how do we compute what is a good weighted average cost of capital, combining both debt and equity. Now, similar to what we have done before, we will go through some of the PowerPoint. Don't forget, go through the PowerPoint. It's on your Canvas. Do not forget also to read your books. It will be good to read your books, not just rely on the video, right? And then also go through the exercise that I will post also on Canvas. So I created an Excel file that would help you see the calculation. So you can press F2 and then see the tabs and whatnot, right? So we'll go through some of the slides, then I'll go to Excel, then we go back to the slides. So we'll do the same back and forth, okay? And then some of them we might have talked about. I'm going to go through some of the definitions just to be sure. So cost of capital in corporate finance setting is an investment made on the future return. Remember that 5 million that we're talking about. It's important to know the discount rate. So the discount rate is basically on our example, 5 million. One of the directors told you, give me 5 million, the return on investment is 15%. The question is, what is my cost of capital? The cost of capital is always expressed in a percentage, which is basically a discount rate. In some books, you would hear, right? So just to be sure that it's not confusing. So cost of capital is sometimes called WACC, which is actually weighted average. Cost of capital is the same, or sometimes it's also called discount rate, or sometimes they would call it hurdle rate. So it's all the same, it's still cost of capital, but the most important one that you need to understand is that cost of capital consists of two things, debt and equity financing. And each one, like debt has a percentage, has a rate, plus the weight, the cost of equity, which you need to weigh. You weigh it. You weigh it, meaning that you need to use a pro rata allocation. Why? Remember our discussion before, right? 5 million project needs to be funded. A return of interest of 15%, but you're going to be funding it using 3 million of so 3 over 5 of debt and then 2 million of equity over 5. So 2 over 5 multiplied the rate, that's your cost of equity. 3 over 5 multiplied by the rate of debt or the cost of debt, that would be your debt cost. And then when you add both cost of debt and cost of equity, that's cost of capital. I want to make sure we will talk about it a lot, but so cost of capital is basically cost of debt plus cost of equity. And then cost of debt, so KE, E would be subscript, right? I could not do subscript here. Cost of debt KD. So basically this is WACC. So when you allocate it, and then I would need to multiply it with say debt over debt plus equity. I'm not gonna complicate it as much. Think about it, we're in plus, let me do not. Anyhow, guys, I'm gonna be moving it, which I could not move. Okay, cost of equity multiplied by equity divided by debt plus equity. So what do I mean? So remember cost of debt in our example right now, we need to derive what it is, right? Multiplied by how much is debt? 3 million. 3 million divided by how much is debt? It's actually 3 million. Okay, I'm going to do 3 million. So 3 million of debt plus how much is equity? 2 million, right? Plus, and then I need to do a bracket on that one, plus the cost of equity, which is actually multiplied by, or the rate of equity multiplied by 2 million. That's the equity that you have, right? Divided by 3 million plus 2 million also. So that's why there will be a pro rata allocation. The cost of equity and the cost of debt are rates or percentage, and then you multiply it by a pro rata amount. Yeah. So that's WACC, a weighted average cost of capital. When you add both, add here, that's why there's an addition there, then it would mean that that will be your that will be your calculation. Okay. So that will be basically WACC, weighted average cost of capital. Okay. I'm going to be repeating it a lot of times, and you're going to see it on the Excel file. So by the end of the video recordings, you're going to be seeing it. Now, here, overall concept. So investment should not be judged on against a specific means of financing used to implement. You can have both on debt or equity, or a pure equity or a pure debt. So in our company right now, we try. I think we are a bit more risk averse. We try not to do much of loans, so we don't ask the bank to give us money. Not because we have a lot of money, but it's just that we are good with managing the balance sheet, meaning that any net income that we have after we make a declaration of the dividends, those are reinvested back to the company. And then we have built a lot of retained earnings wherein if we need to have a project, we can finance it internally without incurring debt. So that would be we call that equity financing, because I'm using retained earnings not to declare dividends to the shareholder, but to use it to reinvest back to the business by funding assets or projects. Yeah. So we actually always think about it, what's the best way of deploying the capital? So loaded cost. So the question now for some on this in the theory side, what is better though? Which rate is higher, cost of debt or cost of equity? When you think about it, cost of debt can actually be cheaper compared to cost of equity. Why? Cost of equity is a rate that is expected by the investors. The cost of debt is actually the rate that is when you loan from the bank, basically. Now, there was one point in time wherein when you make a loan to the bank, it's super cheap, right? So your mom and dad, your aunt, or any family members, you might have heard them saying that they would like to get a mortgage or buy a new house. Reason why? It's good to buy a house a couple of years ago because the rate is actually low. You've heard that before. Or sometimes they might do a refinancing because the rate is lower. So meaning incurring debt is actually low, but interest rate or expectation coming from investor is actually higher. So if I'm an investor, I would say that what is the rate of the treasury bonds right now? Say 5%. Okay, if I would want to invest my money to a private company, equity, by basically buying stocks, right? That's why it's equity, buying stocks. I'm an investor, point of view, not the issuer. I would want to have a return higher than what the treasury bills are making. Why? Because I know if that company pulls out money to invest on projects, they should double it up, or they should have a higher return. Because if not, I'm just gonna buy bonds. But I would not want to do that. I want my money as an investor to be higher, and my benchmark is the interest rate or the bond rate. That's why it's always important when the Feds talk about the rate and then whether they cut it or not. Because now the question is that is it cheaper to actually incur loan to fund projects or to expand a business if I'm a company or a personal if I'm an individual to actually incur loan for a house or a mortgage, right? So what we're trying to say is that debt is normally a lower rate compared to equity, the rate of equity. Now, here we are going through Baker Corporation, right? And then we will eventually compute this one. So, but maybe what I can do now is that start it on the Excel file. I'm just going to go through the next stages. Okay. We will have, so don't worry, whatever you have on the PowerPoint, I I typed it in Excel, but I made it wherein there's a flow. So I'm going to move around the Excel. Want to make sure that we have a flow. Okay. So it's the same problem. I just typed it in, but I organize it so it's easier for you to review, right? So let's just take a look on the Excel file. We have three tabs on the bottom. I have an overview. These are basically the theory with the formula and the calculation. We'll go through it, not a problem. We have the calculation on the cost of capital, and then I'm going to include KGAR. KGAR is a compounded annual growth rate, or basically what's the growth rate between one period over the other. It's a calculation that is important as we talk about cost of capital, and then that's the extra calculation, short one that we're going to do. Now, I have here on the left side a hierarchy. I was thinking, what's the best way to talk about cost of capital? The best way is to make sure that everybody understand there are two components on cost of capital. Cost of capital can be done through debt financing. Either you issue a bond or you take a loan, or you can combine if you want. So it's bond and slash or loan. For now, we're saying either a bond or a loan, right? You issue a bond to get money from bondholders, or you obtain a loan from a bank. You can also raise capital by asking investors through issuance of common stock, issuance of preferred stocks, or using your own funds right now through your retained earnings, what you have accumulated. So here, under equity, you can use your existing earnings that have been accumulated if you have not used it other than dividend payments, or you can issue new stocks. And then issuing new stocks would actually have a different calculation. Why? Because there is a cost to underwrite there's a cost to register, there's a legal cost to issue new stock. So we call it flotation cost. So we're going to consider that as part of the cost of equity. So right now, cost of capital consists of cost of equity and cost of debt. Okay. And then when you think about it, let me just make sure it's a different color. It's going to get confusing later. KD, small letter d, is cost of debt. K is actually cost, right? K. And then letter E is actually cost of equity. Okay, I'm going to clean it up. So I have numbers here because we're going to go through number 1, 2, 3, 4, and then we go back again to cost of capital number 5. So on the left side, we have the same numbers to show the flow of what we need to calculate, okay? Just to make it easy for everybody. But I would always say read your book, but I put most of the items in the book also on the Excel file. But it's always good to read the book. Now, cost of capital. Let me just change cost. So cost of capital is basically a question of there are alternative sources of financing, and then the cost of capital is the price that the company pays to finance its operations or project. You remember that 5 million we talked about, either through borrowing money or issuing stock. So it's a company's cost of using the funds to grow and invest. Okay. Now, here, we will do first the cost of debt. And then the cost of debt is either we're using issuing a bond. Remember why? Y is basically yield to maturity. And that's a calculation of the bond issuance, right? Or it can be a rate of debt if you are actually incurring a loan. Now, the cost of debt, KD, and let me make sure I can actually zoom in. Then we'll zoom in, zoom out, right? So it's easier to you guys to see. Cost of debt is basically the interest rate a company pays to borrow fund, such as loans or the bonds. So it represents expense of the company that incurred to finance its debt for its operation or investment. Now, the cost of debt, or KD, right, is equals to, if it's a bond, is the yield to maturity multiplied by 1 minus T. What is letter T? T is actually your corporate tax rate. Okay, so T is the corporate tax rate. And then if you do 1 minus T, so right now, what's the interest rate? I'm I'm a I'm an old-time accountant. I always use a calculator, right? So it's 21%. I need to do it mental math, but by default, I just do I pick up my calculator, which is always on my desk. So 21% is the tax rate right now. And then it would mean that if I have 1 minus 0.21, it will now be equal to 0.79 or 79%. So it would mean that I would multiply the interest rate if it's a debt or the yield to maturity if it's a bond, and then by 79%. Why do I need to multiply it by 79%? The reason why is that interest expense that you incur are tax deductible, correct? Yes. So it's tax deductible, so you have a benefit of lowering your net income. And then that's the reason why we need to deduct it. And how do we deduct it? By, instead of multiplying by 21% and then deducting that amount, you just basically do 1 minus 0.21 or 79% multiplied by the rate, which is the either the yield to maturity or the corporate tax rate. We will do an exercise later on, so we would actually get a lot of this one. Okay. So hopefully so far so good. I'm gonna go now to, so we're good with one a bit, cost of capital. Then we go with the bond, the debt. The theory is the formula is actually KD is equals to the rate or the yield to maturity multiplied by 1 minus the tax rate, letter T. Okay. Now, I'm going to go now to equity. Equity, we have two parts. Okay, so I'm going to go here to the right side. Let me go and then let me make it a bit bigger. Okay. Okay, cost of equity here. So the cost of equity, we will call it KE, is the return that the shareholders expect for investing in a company. Since the shareholders takes on more risk than lenders, because of, like if you take a loan, the first thing that you need to mandatorily pay the bank first when you go into a bankruptcy proceeding, right? Shareholders are the last one to get paid. So that's why it's the rate. That's why we talked about it. Cost of equity is more risky, and then thus, if you invest on a riskier environment, you expect a higher return. Yeah, because if you just incur a loan, normally that loan is always getting paid because if I'm the issuer of the loan, I would need to make sure I pay it because it's part of the contract, right? You don't actually engage with so you don't tell your shareholders that that they are guaranteed to get dividends every of the same amount every time. Sometimes dividends do change, or sometimes they don't declare dividends because they want to reinvest it back to the business. Like Apple, it took Apple a while to issue dividends because what they're trying to do is that they're trying to invest it on R&D, research and development, and then most of the business itself. So equity, cost of equity is always higher because it's riskier. That's why it has a higher rate compared to cost of debt. Now, this return is the company's cost of using equity to fund its project. Now, KE, or cost of equity, you have two ways of calculating it. I'll do some acronyms right now, but later on, by the end of the videos, you would actually memorize the whole thing already. So you can compute cost of equity either through CAPM, so we call it CAPM. CAPM is actually Capital Asset Pricing Model, so CAPM, Capital Asset Pricing Model, or there's an or the DDM, the dividend discount model, or sometimes called as the dividend valuation model. DDM, dividend discount model, or the dividend valuation model. So why do you have two formulas? Number one, CAPM is for, you use CAPM for companies that don't declare dividends. But if the company is declaring dividends or you are declaring dividends, your cost of capital can be, you can use the discount model or dividend discount model as your basis to calculate cost of equity. But if you don't issue dividends, then you will be able to use CAPM. Now, CAPM, we have at one time we have one class that we just talked about CAPM because it can go a bit crazy, but I'll give you a high level discussion of CAPM, right? So CAPM is basically, we use KJ. K means cost, right? J is actually for a return right now. We assign this to KJ, but for in the book, right, they assign KJ because it's a common stock. But technically that's KE, right? So we'll just say KJ for sake of argument right now is equals to the risk-free rate plus the beta of the difference between the market rate, which is actually KM, minus the risk-free rate. So basically, that's the formula of CAPM. So the risk-free rate plus a beta multiplier of the market rate, KM, minus the risk-free rate. So it's actually here. Risk-free rate and multiply by the beta or plus, right? Plus the beta of Km minus Rf. And then what is risk-free rate? Risk-free rate is actually like a treasury rate for treasury bill securities. So we normally use the 20 years. When you think about technicalities, You can use the 20 years, not the 30 years, depending on the industry that the company works. But for now, we'll make it easier. We'll just say risk-free rate is actually treasury bills. Where do you get the treasury bills? If you type in treasury bills online for the US government, it will give you a 20-year rate, and then that's basically the risk-free rate. Why is it risk-free? Because it's guaranteed by the United States government. And the United States government has not defaulted on any treasury bills. So remember, there was a discussion before that China, at one point in time, maybe might still be, holds a lot of treasury bills because those are guaranteed. So if China wants to invest, China or any investor would like to invest money on somebody that guarantees a payment of coupon or bond rate or interest rate to you every year, or depending on the agreement, it can be a semi-annual or quarterly, right? So those are treasury bills. It's always guaranteed that the US government has not defaulted on it. That's why it's risk-free. Now, what's a beta? A beta is a coefficient, or basically, beta can be 1.2, 2.0, it can be 0.95, 0.10, 0.50. So it's either a value of less than 1 or greater than 1. What do I mean by that? A beta is actually a measurement of the historical volatility of an individual stock rate. In this case, if it's us, we're computing our cost of capital and we're a listed company, we would reflect on the volatility of our own stocks relative to the stock market. So if we're Apple, we're computing our beta over the S&P 500, right? So Apple is a technology stock, and if we actually move, more likely than not, uh, it moves also with S&P 500. So that's why, or the index fund. That's why I would say that that will be more than one, because if it's positive, it actually moves right together with the market. But it doesn't, if it doesn't move the same way. So for example, here's the here's Apple, and here's the S&P 500. If it's like that, so it means that it's positively correlated, and then more likely than not, it's one or one point something. But if it's not, it's like here's your S&P 500, and then your return is actually like moving not the same, it's not synchronous, then it might be less than one, like 0.95, 0.8. So it's correlation, right? Um, Let me just make sure we have that. And then don't worry. So beta, for our purposes on the undergrad, it will be given, right? In the master's program, we actually do this like, okay, calculate the beta. Their project will be, show me how you calculate beta. But for now, we would actually give it on the problem. Or if you go to Yahoo Finance, you can find a company's beta. So let me just make sure I can actually do that. So if I go to, let me go to Google here. If I go to Yahoo Finance data, Apple, I say Apple, right? And then I go to Apple here, I clicked it, it should pop out. And then the beta here, beta for 5 year is like, yeah, 1.24 or greater than 1, because it moves together with the S&P 500. For example, here is the S&P 500 movement. It's almost mimicking the same as the Apple stock chart, right? That's why it's positively correlated 1. So basically, wanted to give you, so you can use Yahoo Finance, Morningstar to pull out beta data. Now, for now, that's actually how we want to do it on CAPM. If the company, of course, Apple declares dividends now, like there's dividends declaration and whatnot. If the company declares dividends, there is another way to compute cost of equity, which is actually called the dividend discount model or the dividend valuation model. It's the same. Okay, it's the same. Certain books call it different and then differently. So I wanted to make sure when you read another book or you browse something online, it's like, okay, are we talking about the same thing or not? So it's the same. And then how do we do that? Um, Remember this formula before of the price of the stock today is actually the dividends divided by KE, which is the required rate of return minus G. Remember, we had that last week. And then if we, I would say extrapolate, if we do a solve for KE, algebraic expression, right? It would be like this. So this is basically the formula. The dividends being declared by the company divided by the price of that stock today plus the growth rate is equals to the cost of equity, right? It's basically the same thing here. It's just that we use CAPM if there's no dividend declaration. But if your company declares dividends, you can actually use the um, DDM model, right? Or the discount, a dividend discount model. If I say DDM model, it's redundancy, right? Okay. So if the equity now relates to a new issuance, so we need to be careful because sometimes is it an existing cost of capital or cost of equity, meaning that you're using retained earnings? You can use this if you're declaring dividends. If not, you use CAPM. But if you're declaring dividends and it's a new type of issuance, why would you say, how would you know that you're going to declare dividends if you're going to be, it's new, right? Because what will happen is that the preferred stock, most preferred stocks, they need to actually have a preference for declaration of dividends, and anything after that goes to the common stockholders, right? So that's why I want to give a background why the logic into it. When you think about it, finance is always about logic, but why does it work that way? So hopefully, as you go through your course in business, and then you go if you do your masters, you always ask the question, but why? But why? Why does it work that way? Because it that's when everything gonna get all linked out. For now, we're giving you an idea of how is the logic behind a cost of capital and then the calculation behind it. If the cost of equity is actually a new if the equity is a new issuance, then you need to consider the floating cost. So what is the floating cost? Oh, a floating cost or flotation cost. Flotation cost refers to the fees and expenses that the company incurs when raising new capital by issuing or through issuance of securities. It would be like underwriting, legal, and registration fees. And then this cost is expressed normally on a per share basis. So remember that this formula did not consider flotation cost, but this formula, so remember K is cost, right? N will be new. E is actually equity, but this is new issuance. And then J is the cost of cap M, no dividends basically. It's the same here, but we now consider F. I need to deduct from the stock the per unit or per stock basis of flotation cost before I have so this is your numerator, here's your denominator. Before is only the price of the stock, but now I need to consider deducting the flotation cost before I add it with the growth rate. Okay. So not too bad. Of course, we would reinforce it with calculation. I'm gonna go back here. Now, we are now on number 5. I'll make it a bit smaller because I need to show you the linkages now. Okay, I'm gonna move it here. We are now talking about the weighted average cost of capital. Why? Because it's both the cost of debt, it's both, right? And the cost of equity. The cost of equity can be using CAPM, can be using DDM, which can actually be without flotation costs, or if it's a new issuance with flotation costs. Still with me, right? Now, the weighted average cost of capital represents the average. That's why we always say average, right? So represents the average cost of financing. And then KE, which is cost of equity, and then plus KD. Making sense now. But there's a multiplier. What's that multiplier? It's actually, so KE is equity, right? So it's the equity amount or the market value equity divided by what's V? V is basically equity plus debt. So you basically add this one and this one. Remember our discussion before? If my equity is actually 2 million and then my debt is 3 million to finance a 5 million project. So I would say for KE, I have the rate, but my multiplier, which is this one, is actually 2 over 5. How do you get 2 over 5? 2 is your equity divided by V. What's V? V is basically equity of 2 million plus debt of 3 million, right? That's the pro rata allocation. Similar to cost of debt. If I compute the cost of debt calculation, I still need to multiply it by D, 3 million, divided by V, which is equity plus debt, which is 3 million plus 2, so it's 5 million. So that will be 3 over 5. So you have a rate multiplied by the allocation. You have equity, cost of equity multiplied by the allocation. Add it both, then that's WACC. Okay. So in a way, it's simple to remember. Maybe first time might be hard, but it's simple to understand. And then from there, we will go to the calculation part. So I'll do it in a two video exercise. So we would actually have 2 videos for today or for this week. Overview, we're going to end it, and then we would see you on the next one wherein we do the calculation and the KGAR. Thank you, everyone.